What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we're talking about the new executive order that President Donald Trump has signed into law on Thursday and what it means for your 401k account. So if you're excited for today's video, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. And again, if you're not subbed to Fridge Financials, where else are you getting this free financial education content here? I know like 87% of you guys are watching the videos, maybe aren't subscribed to it. So if you aren't, either feel free to, or leave a comment in the comment section below. Hey Fridge, I would like it if you did this. Hey Fridge, I would like it if you did that. Or I honestly just forgot to subscribe to the channel, which would obviously be fine. So we're going to break down this idea of what Trump has just signed in as an executive order, and he is going to be changing 401k investing at least for while he's in office, until I don't know if they can flip this back around once he's done here. But honestly, this doesn't seem like a bad idea. And we're going to talk about it, go through an article, look at some research from BlackRock and Larry Fink, and kind of go from there. So experts advise caution in adding private assets like crypto to 401ks. This is going off of the fact that President Trump signed an executive order smoothing the way for 401k administrators to include private assets in their plan offerings. Okay, so he signed it into effect on Thursday, and to focus on the 401ks, the directive instructs the Department of Labor and the Securities and Exchange Commission to draft guidance for defined contribution plans to incorporate private market investments, including private equity, venture capital, hedge funds, real estate, and possibly gold and crypto. And at the time of recording this video, Bitcoin is around 120,000. It's had a big rally since this came out on Thursday, which does make sense because, again, if you can put crypto into a retirement portfolio, because you really don't, the 401k, managers don't put your assets into crypto. Usually it's like stocks, bonds, ETFs, those kind of things, not crypto. If there's exposure to crypto in the retirement plans of a 401k, that's just going to increase demand even more. And with a limited supply of Bitcoin, is going to push Bitcoin to higher and higher prices. This could be potentially a big catalyst for Bitcoin long term if they can start to come up with this guidance for including venture capital, hedge funds, real estate, crypto. All those things are very, very good possible investments to help boost your 401k. And we're going to talk about more as we look through this article even more. Backers say the shift offers diversification from the plain vanilla stocks and bonds and potential juiced up returns over time. As we talked about things before, diversification in your investments is key. You don't want to have all your eggs in one basket. You don't want to have all your money into real estate, all your money into Tesla stock. You want to have it spread out throughout different companies, different sectors. So that way, if one sector goes down, hopefully the other ones can make up for it, which is diversification. The S&P 500, investing in a ticker like SPY, is a good way to start because that already invests in the 500 companies of the S&P 500. So it's diversified in that aspect. You get exposure to Tesla, to Nvidia, to Google, but you're not putting all your eggs into one basket. So that's kind of what they're talking about here, saying, hey, give these people who want to invest for their future, let's give them a possibility to invest into crypto, into infrastructure, into real estate, into private equity, those private trading companies. Give them a chance to get that because those have more risk but more return, which could make their retirement be even higher than what it should be at, which is obviously no one's going to complain. But they do have some red flags that comes with this as a result. First thing is that private assets come in a panoply of flavors. Now, what a sentence. Let me tell you, never heard of this word in my life until just now. They all have different returns and risks, and you need to understand those differences. This is Lisa A.K. Kirchenbauer, Senior Advisor and Founder of Omega Wealth Management. That's Hold Yahoo Finance. If you don't invest. Basically, long story short, if you don't know what you're investing in, don't invest. Peter Lynch is also known for saying that if you don't know and understand what your money's in, stick with traditional investments. If you have no idea what crypto is and the logic and the reasoning and the use behind Bitcoin, Ethereum, XRP, Cardano, all these different cryptos that have potential to hopefully make strides in the future for us as a country, as an economy. If you don't know them, don't invest in them. If you don't know real estate, really, maybe don't invest in it. If you don't know private equity companies like OpenAI and SpaceX, don't invest in them. You have to know what your money's going into, and you have to build that foundation first. If you don't know it, don't do it. That's basically what she's saying here. That's a good cautionary thing just for any investor, whether you're investing in regular stocks. Don't jump into a meme stock just because it's trending on Wall Street bets. Do the research behind the company, look at the fundamentals, get an understanding of what the company does in and out to the best of your ability. It'll really help make you feel convicted when you invest in these kind of companies. Unlike stocks and bonds, these private assets are less liquid and can't be easily sold if cash is needed, making them less suitable if you have a shorter time horizon. For example, if you will need to start taking required minimum distributions, or you roll over your 401k to an IRA when you change your jobs. And this right here is a very big important aspect. The keyword liquidity. Liquidity basically means how easily are you able to buy into a position? How easy are you to sell a position? Tesla, Amazon, Meta, Nvidia, all publicly traded companies with millions and millions of shares to trade, gives you the ability to get in and out of the trades relatively easy. With private equity and private assets, it may not have as much liquidity. Instead of having millions and millions of shares on the public market, you might only have 1 million shares in the private market, which means that you need to find a buyer when you sell. You need to have a buyer to buy what you're selling. And if there's not a lot of buyers, you either got to lower your price and lose some more money, or you got to sit there and just wait until someone comes in and buys it. So liquidity is a very, very important aspect when it comes to private assets. Again, if you need the cash, you want to get out of positions, you need it. If you are taking a required minimum distribution, which means you need to take some money out of your retirement account and it's in private equity, you have to offload that somehow and you need the liquidity for it. You also, if you need to roll over your 401k to an IRA when you're changing jobs, if you get a job somewhere else and you roll over your 401k to an IRA, you need to close that 401k and close those positions to then roll it over. To close positions means to sell. So private equity is unlike public markets because there's less liquidity. So that's something you need to understand and keep in mind about for it. You need to understand liquidity or don't invest. Very similar. For someone planning to keep their assets in the same plan for a while, even in retirement, it may make more sense. If you think you're going to be at your job for the next 20, 30 years and you're not going to switch and you're not going to retire, not a bad way to keep it locked up for 20, 30 years. If you're looking at retiring in 5 years, probably not a good idea. If you feel like the job you have right now is just an entry point and you're going to be looking to move somewhere else and relocate potentially to a new job and a new career, or it's a temporary job just to make, bill payments, stuff like that, probably shouldn't do private equity. Things to keep in mind about. She added that if you decide to invest, you should consider keeping it to a maximum of 5 to 10% to start. That's 100% correct. Until you really start to understand private equity and your private investments, start off small, 5%, even 1%. Get that exposure, but don't go crazy with it until you get a really good understanding of it. Once your understanding is there, you want to go 15 to 20%, feel free to. It's all about how much you are willing to put in to understand the ins and outs of private assets here. But what's interesting is that now it talks about BlackRock's CEO, Larry Fink. And BlackRock owns trillions of dollars of assets under management. They own a lot. They have a lot of assets that they manage for major clientele. So BlackRock CEO Larry Fink has taken that data even further. Instead of doing a 60-40 split between stocks and bonds, he said it may be a 50-30-20. 50% stocks, 30% bonds, 20% private assets, like real estate, infrastructure, private credit, that he wrote to his clients back in April. Now, this is also what's interesting. Fink points out that pension funds have invested in them for decades. So pension funds are different than 401ks. For example, I am an educator, and my part of my paycheck, I have money taken out that goes towards the teacher retirement board, which they then take, and it's a pension. Pension is different because it's fixed income that you get once you retire. It doesn't matter if the S&P crashes 10%, 15%. My retirement account won't change like a 401k will. I get a fixed distribution in my pension every single year when I'm in retirement. 401ks depend on the market. If you still have, 30% in the market, you could still lose some money in your 401k. So it's a little bit of a difference there. There's a lot more to it, but that's kind of just the major surface area to focus on there. But what he says here is that since pension funds have done it, but 401ks haven't, pensions typically outperform the 401ks by about 0.5% each year. But again, 0.5% each year doesn't seem like a lot, but if you do it for 20, 30 years, you're looking at 15% returns that you're missing out on additionally to what you got because you're not investing in private equity. So it's very, very interesting to think about what we're talking about here. And I did go into Larry Fink's letter here. Here's Larry Fink, the gentleman that is worth a lot more money than I will ever see in my lifetime here. And we talk about what he goes into with investing in private equities and stuff like that and how it works. It talks about the S&P growth and the GDP growth here. Right here, investing into private markets. So we go down here. There's a really good point that I wanted to focus on here, was just talking about private equities here. It's this right here. Private equities, he listed one of the things was also infrastructure. There's a 68 trillion investment boom. Who will own it? Throughout history, infrastructure has driven a surprising amount of economic growth. Between 1860 and 1890, so way, way back in the day, just building railroads boosted the GDP by 25%. A century later, the highways are the same thing. By one measure, investments in the interstate system accounted for about a quarter of productivity gains between 1950 and 1989. Today, we're standing at the edge of an opportunity so vast, it's almost hard to grasp. By 2040, the global demand for new infrastructure investment is $68 trillion between now and 2040, so about 15 years. To put that price tag in perspective, it is roughly equivalent to building the entire interstate highway system, like all the highways that are in the country, and the transcontinental railroads from start to finish every 6 weeks for the next 15 years. That is how much money is being put into infrastructure. And you can take a look and see that we're looking at $25 trillion in roads, 21 in energy, 8 in railways, 6 in telecom, water, airport, ports, all that stuff. Absolutely amazing. There's a lot of money here to be made with infrastructure. Very, very interesting article to take a look at and to read here about where we're going. Even the world's largest tech companies, despite their billions in cash flow, aren't equipped for this scale of investment. A single AI data center can cost between $40 to $50 billion. Everybody's saying the AI bubble thing is here. AI is here to stay. I don't think it's like the dot-com bubble in 2001. It's here to stay. There's so much money being put into the AI sector, whether it's through, infrastructure, whether it's through, ChatGPT, whether it's through, automation with robotics and stuff like that. There's so many things that can go. This is just the beginning. Talking about private markets here. This is really interesting as well. Most companies in the US, EU, and UK are private, which is interesting. So distribution of public versus private companies with revenue greater than or equal to 100 million each region. As you can see, we do have the most public market compared to the EU and the UK, but a majority of companies that have over 100 million in revenues are private. And then so we go into this PowerPoint presentation here back from that they referenced in 2022, which is also very interesting. Private assets have higher expected returns than publicly traded assets according to our CMAs, meaning that adding allocations to higher returning assets should increase the overall return in the portfolio, as you will see in Figure 1. So Figure 1 says in 1995, investors could meet return objectives through a portfolio comprised of fixed income and cash. So you can get a 7% return in fixed income and in cash. Fast forward to 2010, it's fixed income and public equities and stock markets and investments. Gives you the same 7% return. A lot less fixed income, a lot more into public investments, into those public traded companies. Now, to get the same 7% return, you need to have an allocation to private markets. In order to get that same 7% return that you got in 95 and 2010, you need to have less money in public and more in private. And the interesting thing to note, cash was here. You don't even see cash anymore in 2010, 2025, because cash loses value, as we know. Very, very interesting thing about here. And also what's very interesting is this. Adding private assets diversifies the overall portfolio, which is what we want to have, diversification, and thus enhances its risk return profile as illustrated in figure 2. This chart showing a static portfolio does not directly translate into how we would approach incorporating private investments, but it does illustrate the point that private assets could improve risk return and also boost up your investment return. Take a look at this figure here. Here's your regular 60-40 portfolio split. So with 60-40, your risk is about 10 to 11% here annualized, and your returns are about 6 to 6.5% return. When you include private equity, you diversify more, and the more you diversify, the less risk you're taking on here. And also, since private equities usually tend to do better overall, they also increase your annualized returns. So Larry Fink and BlackRock make a very good point here of saying it's going to diversify your portfolio, but it's also going to reduce your risk and potentially increase your annualized returns. It's a win-win. You reduce risk and you increase your returns. If someone told you, hey, Fridge, I would love you to invest in this because it's going to de-risk your portfolio and increase returns, sign me up. Slap the credit card down on the table like that meme and literally do it, because that is a win-win situation. Can't complain about it. And Larry Fink, again, CEO of BlackRock, who has trillions of assets under their management, has a very compelling point here. So this is something to keep in mind about. And again, the risk that you have here, obviously with bigger returns, does give you bigger risk. So you have to be mindful of the risk to return you are going to be getting here potentially. But private investments is a big thing to get into. And I think this is going to be game changing for 401ks. Now, for me, as someone who has pension, not as much. I do have a separate 403b account. So if this does go into 403b accounts, I would also be interested in seeing that as well. So that is what President Trump's executive order is and how he is changing retirement potentially forever. They can always go back and and take this order out once he's not being the president anymore. He could overturn this, whoever's next in charge. But if we see some good data here, it might stay for the future, and I'm all for it. So thank you guys so much for watching today's video. Again, if you made this far in the video, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. I hope you're making money in the market, whether it's through your 401ks, through cryptos, private assets, real estate, infrastructure, you name it. Hope you're making money somehow. And as always, I will see you guys in the next video.